This is from Don. And Don says, is there anything special I need to know in placing an out-of-the-money bull put credit spread on SPX? The reason that I ask is I'm considering placing some funds that aren't generating much income, a 4 or 5 delta. I don't know if he has that phrase exactly right, but we'll take a look at it. What he means is about 20% below current price. I think what he meant was a 0.04 delta. When I read that, I thought maybe he meant 0.4 or 0.5, which would be an at-the-money delta, which you don't want to do. But with 20% out of the money, a 0.04 or 0.05 delta is what I think Don meant. But going 30 to 45 days out in time, every month, every cycle, 30 to 45 out, to generate 5 or 6% per year. I'd appreciate your thoughts. All right, Don, well, excellent question. Let's go ahead and take a look. Here is the structure. A 20% out of the money short put right now on SPX would be 31.20. Using that based on the close is about 3,900. I didn't see it. I was putting these slides together right before the close. SPY was around 3,000. SPX, excuse me, folks, was around 3,985, as we can see here on the chart. A 30 to 45 days out, let's just stick with that standard third Friday expiration. The July series, July 15th, it's 35 days out in time from today. Now, we don't have a 31.20 due to SPX pricing. We're starting off with a 31.25, and the next lowest strike is the 3,100. There's nothing in between. At midpoint prices, right before the close, it was a little bit lower at the close, I believe, but we could sell that 31.25 put for 545. Buy the 3,100 put for 510. This gives us a net credit of 35 cents, but with a $2,500 margin requirement. Or I'm sorry, if I say 35 cents, yes, I should say $25. For one contract, we're looking at taking $35 per margin requirement of $2,500. The maximum risk, if SPX is below 3,100, roughly about a 22% decline in the position from now, is 2,465. That margin required minus the 35 we took in. And the maximum profit is 35 or 1.4%. The pivot put, the sold put, the 31.25, has a 96.6% probability above and a delta of minus 0.029. Let's just call it 0.03. So that's that 4 or 5 delta he meant single. As a decimal point, it's 0.03, roughly in this case. If he is able to do this and it works out for him every 35 days, will he get that 5 or 6%? Well, sure. Well, in the next 6 months or so, he's getting about 1.4% roughly for the next 6 months. So we'd be roughly at about 8.4% return. Now, I don't know how much you're allocating to this, Don, but keep in mind, looking at these net credits, and I know you know this, I know commission fees are much lower than they were in the old days. In the old days, what I mean, when I first started out with earning, even back in 2008, to trade a condor or a credit spread at something like Options Express, you were almost looking at $15.95 to $20. If I just did one contract on a spread and I'm paying $7.95 for each, or roughly $15, I'm taking a huge chunk out of the potential profit. Now, if I did 3 contracts, okay, I'm making about $105, but I'm also putting up $7,500. So you got to be careful with that, with these deep out of the money positions, depending on how many contracts you're trading, how much you're allocating to the position, and the effects of the commissions on the trade. Even now with commissions almost non-existent, I understand, but that is one thing you want to consider because you're taking in such a low net credit, looking for that such a high probability in those cases. Now, a general approach for bull puts on standard stocks that match our criteria that you've heard me talk about before, we generally look for an 85% probability or higher. Your structure has that, obviously. That would usually equate to a delta of minus 0.17 or less. You're well within that range. We look for shorter time frames in general for a higher annualized return, right? We know, of course, that selling an option that's 6 months out in time is not 6 times the cost of the near-term option. In general, our time frames we look for are maybe 10 to 25 days out in time. So you're a little bit beyond that. But I know with your criteria you're looking for, doing something that's 10 to 14 days out in time, you're not seeing a net credit of 35 cents. You're seeing a net credit of maybe 12 or 15 cents. You'd get a higher annualized return in that case every 10 to 14 days, but how much is that affecting with commissions and more? And we'd look for a 9% return or higher to have leverage working in our favor. Now, our goals and targets are not Don's. Don's positions is safe regarding the probability. The midpoint prices were not too wide. It was only a 10 to 15 cent difference, so he's likely to get those midpoints and get close to that 30 to 35 cents or that 1 to 1.5% return. Now, many investors, I don't do this personally, on the 8 ways to manage a bull put credit spread and the triggers we use, we know that many customers and many investors like to use a stop of 2 times the net credit or 3 times the net credit on a bull put credit spread. When you start off this far out of the money and you took in a net credit of 35 cents, if the stock falls, the underlying falls maybe 3 or 4% and implied volatility increases again, you might actually see a debit to close that position of 70, 80, or 90 cents. You're close to that 2x or 3x time, which means you might be seeing losses quickly and you might be feeling you need to make adjustments because you're seeing a closing liquidation value that's 3 or 4 times the initial net credit you received. And that's because you received the lower net credit up front. You know, if I'm looking for a 9% return on that 25-point spread, naturally I'm taking a much higher net credit and I have a little bit more wiggle room before it starts to come to a 2 or 3x buyback cost. But we're going to take a look at that specific trade in just a moment and see what I'm kind of referring to here about the declines, because the subtle movement down, those out of the money options might jump quickly in price as the stock falls another 5, 10, 20 points. But we're going to use the profit and loss chart to analyze that. Okay, let's take a look at some scenarios on the SPX deep out of the money bull put credit spread that Don was looking at. We've added it into the portfolio, so let's go ahead and navigate to the portfolios. And here we have the SPX 3125 3100 bull put credit spread, net credit of 35 cents for July 15th expiration. Now, I had just mentioned about some of the ideas of management where some investors might use a 2x the net credit or 3x the net credit as a liquidation value of when to close the position so they don't lose too much. And a small concern here was that with such a small net credit coming in of only 35 cents, that with a small decline, even though we're deep out of the money, we might hit that trigger if Don was using that for his position. Well, how we would analyze that is we're going to go ahead and go to the profit and loss chart from our position. And here we have the SPX trade, way deep out of the money, stocks at 3,900, we're at 3125. Net credit, of course, of 35 cents for that 1.4% return Don was looking for. Now, down below in the profit and loss chart, let's just run some scenarios. What happens between now and let's say the halfway point? Halfway between now and expiration would be June 29th. What happens if we see a 5% decrease in SPY? What would our position look like in the next couple of weeks if the stock falls 5%? Well, this would take us roughly down to about 3,700, about 195 down. Let's just call it 3,700 on SPX, a 5% decline in the next couple of weeks to June 29th. And as we can see here, we still have a reasonable profit on the position, $10, meaning if we liquidated, we'd only make $10, of course, not the full 35. We're still in a good position. The position is still profitable with a 5% decrease, even though we're deep out of the money. 600 points to go, so we're probably not even concerned about closing or rolling the position at this point anyway. Let's take a 7% decrease, another 75 points or so, drop us down to 36.25. Where would that put us? So at 36.25, June 29th, expected loss would be $13. Okay, a third, roughly, of the maximum net credit. So we're still not in panic mode. Still haven't hit that trigger if Don was using it, the 2x, 3x the net credit. But a 10% decrease, of course, would bring us down to about 35.10. 390 down, put us at 35.10 from 3,900 midway through. And the expectation, assuming volatility is still the same, would be a loss of $84. So this is that 2x, almost 3x the net credit. Not quite at 105 with 3x the net credit, but it would definitely be 2x the net credit. Now, in our webinar on 8 ways to manage a bull put, where we talk about the exit triggers we use, we do discuss why we don't use personally the 2x or 3x times the net credit as a stop point and what stop points we do prefer. But we wanted to use this time to illustrate that this is what the position would look like for Don with a 5% decrease, a 7% decrease, a 10% decrease. We're not maybe expecting a 20% decrease, but it's important to know and to use the tools on the profit and loss chart because you're getting such a small net credit so deep out of the money to see what the loss might be in this case and if it would trigger, in fact, an exit strategy for you so you know what to expect and if you feel comfortable enough with that because of that smaller net credit, 35 cents, 1.4% return on the 25-point spread that we were looking at for Don being 20% out of the money, 30 to 45 days out in time. But it is important for me, of course, to remind everyone, as always, that today's material are my thoughts on your questions, designed for educational purposes, increasing investing performance and options knowledge. The first discussion on the bull puts there, we discussed the high probability Don was planning and that matched his trading goals. I haven't done any testing on it, Don. I didn't have a chance to do that. I might do that and let you know what I find with historical tests on that kind of structure for the last 6 months or so. My apologies, Don. But any stocks or options discussed today should not be taken as direct recommendations or trading suggestions. You've heard me say that I like to buy shares of the inverse ETF or the volatility ETFs as a hedge for the more leveraged portion of my portfolio. Also scaling back and proper position sizing for doing those types of spread positions. I'm not promising I'm going to buy a position on SH, but I'm going to look into it next week. As we've seen, options involve risk and may not be suitable for all investors. We didn't take a look at the most powerful tool in our arsenal today. We didn't spend any time on the search tool, but we did get to look at the analysis from the portfolio. Took a quick look at the Black-Scholes calculator. We looked at some of the other tools there on PowerOptions, of course. But, the patented search in each of the 23 plus strategies we support to find your perfect position that matches your criteria, using our defaults as a stepping stone to create your own. Different signature tools, the portfolio tools, and more. Remember, you can take a 14-day free trial at any time. Just go to powerop.com and put in your name and email address, and you'll have full access to the site for 14 days. After that, subscriptions start at just $45 per month for the end-of-day data service. The 20-minute delayed service, which gives you access to essentially all the tools and the features except the backtesting tools as well. That's only $65 per month. And, of course, you can upgrade for $100 per month for the delayed with the historical. It's only $35 more. And then, of course, higher prices for the real-time service and the full service as well, the premium service also, which includes the API. Earlier, we discussed some of the education there on YouTube and the webinars. Remember, you can take a look at our education at any time. Let's go to the webinars page on PowerOptions. Go through the 4 categories there, the tools, option strategies, concepts, and requested topics. Or you can go to our YouTube channel, use the search function to find topics on varied puts, bull put credit spreads, index trading, things of that nature. That's all there for you, and you can navigate through it fairly easily. Now, I didn't see any last-minute questions come in. But reminder, if you have any other questions, send me an email at any time to support@powerop.com or support@radioactivetrading.com. You can also call us during market hours at 302-992-7971. And remember, trial members and subscribers can schedule a free coaching session at any time. It's essentially a 35 to 45-minute phone conversation with myself or Ernie. Basically answer any questions you have about the site, strategies, management techniques, a lot like we did today, but a one-on-one discussion. Usually done over the phone, but if you want to request it's done in a webinar format like this, you can mention that when you schedule the session, and we'll get something set up for you.